Hello everyone, and welcome to Alternative Design's presentation of our May product launch. This is Tim Harding. I am the Chief Marketing Officer for Alternative Design, and I want to thank you for joining us. I think you'll be glad that you did. We've got some very, very good products available to you for the month of May, just in time for spring and to get ready for a big summer. So I think you're going to like what you hear today. We've got a number of interesting offerings that I think will position you extremely well with your client base. You know, our theme going forward is now you can go in with a plan instead of just a product, because I think you'll see by the end of today's webinar that you've got the opportunity here to do some real asset allocation, some real portfolio design with market-linked CDs and integrate your FIA product in there as well, because it's linked to a major index like the S&P 500. So as usual, I will take questions at the end of the presentation. If you have a question during the course of the webinar, please feel free to go ahead and just type it into the chat box on your control panel. And as usual, at the end of the webinar, I will pull those questions up and respond to as many of them as I possibly can. So feel free to type the question into the chat box at any time, but I will also pause at the end and give you a moment or two to do that at that point as well. So for the month of May, we have 6 products on our platform, some of them familiar and at least one brand new one. We'll have the usual offerings from Bank of the West, both the commodities and the equity-linked income advantage product. That's the either-or product. You get either the minimum guaranteed of 1% or the maximum guarantee or the maximum return of 7.25% on the commodities or 7% on the equity. Both of those products pay a 2.5% referral fee for the month of May. So those are a little sweeter than some of the other offerings. We have an offering from Barclays, which is a 7-year equity-linked product linked to a basket of 10 stocks. We'll go through that in a little bit. That pays at 2%. Goldman Sachs has a fantastic product. I alluded to it a little while ago in a webinar just as kind of a teaser, but the Goldman Sachs 5.5-year multi-asset linked product, something that I think you're going to want to take a very, very close look at. Again, a 5.5-year duration. I know many of you have been clamoring to have a shorter term product. Here we've been able to find one that's only 5.5 years. An extra 6 months probably isn't a deal breaker, and we were able to find one that actually paid a decent referral fee, 2% on that Goldman Sachs product. The JP Morgan 7-year high yield bond linked product that we're so high on is back. That's a 2% comp. And then the ever popular, and rightly so, Bank of the West product linked to the Morningstar Ultimate Stock Pickers Index. So compensation this month between 2 and 2.5%, depending on your product mix. But I think as we walk through these individual offerings, you're going to find a lot here that you really like. And I think if you weren't enthusiastic before, you will be soon. So let's start off with the commodities offering. We only have one again this month. It is, of course, the Bank of the West Income Advantage product. Minimum guaranteed interest rate of 1%, a maximum interest rate of 7.25%. Nice returns if you can get them. Of course, this is what I call the either-or product. It's linked to a basket of 5 individual commodities products, sub-indices of the S&P GSCI index, the same ones we've had for the last several months: cocoa, coffee, corn, lead, and natural gas. And if all of those 5 commodities are equal to or greater than their initial share price on the trade date, then the client will receive the maximum interest payment of 7.25%. If one or more of those commodities is below its initial price, the client will receive the minimum guaranteed rate of 1%. Now, I know that many of you have been skeptical of this product, as we were when it first came out, because you have to have 5 different reference shares positive in order for it to pay the maximum payment out. In other words, you one bad commodity in there could result in the payment of only the minimum interest payment, even for the full duration of 7 years. But some interesting things, commodities run in a cyclical manner, and they've been down. And there's no question about that. Those of you who have clients in commodities products have been acutely aware of that. But because they are cyclical, they do tend to come back up. And, we took a look at the 10 income advantage commodity products that we have offered on our platform. We only have 10 of them out there. And what we found was that in every single case, 4 of the 5 underlying commodities were positive, some of them significantly positive. I mean, you'll notice from this particular performance graph for this particular CD, coffee's up over 50%, cocoa's up 25%, natural gas is up over 20%. The only thing we've got going here is lead, which has been negative. But you'll notice it's not negative very much. And since the first one we issued was in the month of July, we're thinking there's a pretty decent probability that by the time it comes time to calculate the interest payment on these commodity CDs, there's a very, very good possibility that all 5 of these underlying reference shares will be positive, which means some of your clients are going to get a very, very handsome interest payment, especially for a product that's principal protected and guaranteed and FDIC insured. So commodities are coming back. We've been preaching that for a long time. Just stick it out. But they do appear to be coming back, and as a consequence, some of your clients are going to be getting some very, very nice returns. That will be the only commodities offering we have on our platform for the month of May. So let's turn to the equity offerings that we'll have this month. Of course, we'll have the counterpart to the commodities income advantage product. We'll have the equity income advantage product. Once again, from Bank of the West, a 7-year product. Minimum guaranteed annual interest rate of 1% or a maximum of 7%. Works the same way. It's linked to 5 individual stocks, stocks you're familiar with. They don't change very much from month to month. They seem to like Apple, AT&T, Bristol-Myers, McDonald's, and PPL. We've seen all of those before in previous offerings. So once again, this product works the same way as the commodities offering. If all 5 of those stocks are equal to or greater than their initial share price on the anniversary date, the client is going to receive the maximum payout of 7%. If one or more of them is negative, the client instead will receive the minimum guaranteed interest of 1%. So it's all or nothing. Well, not all or nothing. It's all or less. You get either the minimum or the maximum, nothing in between. So these continue to be very popular products. They're easy to explain, easy to present, and presented together, where you've got a combination of stocks and commodities linked products. An excellent, excellent way to start building a portfolio, since commodities historically have had an inverse correlation to stocks. In other words, when one is up, the other is down. When one is down, the other is up. Pairing these 2 products together would seem to me to increase the probabilities of a maximum payout in any given year. So once again, very popular product line. We have an offering from Barclays Bank again this month. It's also a 7-year product. It has the highest minimum guaranteed interest rate of any of the products on our platform. It has a 1.5% minimum annual interest guaranteed with a 5.5% maximum auto cap. That 1.5% annual minimum, folks, you can't get a traditional CD that will compete with that, especially not one with the upside of as much as 5.5%. So this is a very, very competitive product. We saw quite a bit of activity in this area last month because the minimum guarantees are just difficult to beat. Now, I know there are some MIGAs out there that are a little bit higher right now, but not much. And so if you're able to pick up money with MYGAs, you certainly are going to be able to pick up some FDIC insured money with this Barclays product. It is linked to 10 individual stocks, not 5. Apple is in there again, Duke Energy, we've seen them before, Microsoft, Alteria, Verizon, McDonald's, Intel, Lillard, AT&T, and the Williams companies, so some names that we're pretty familiar with. And of course, this product features the auto cap feature, which is an interesting calculation methodology. What it says basically is that on each individual share, on each individual stock, if on the anniversary date its price is equal to or greater than its initial price, in other words, not negative, the client will automatically be credited the cap for purposes of averaging the portfolio's return. So on the Barclays product this month, if the stock a year from now is equal to or greater than its initial share price, in other words, just not negative, the client will be credited with 5.5% for that stock. And then, of course, all 10 stocks, positive and negative, will be added together and averaged, divided by the number of stocks, 10, and that will, of course, be the interest rate paid to your client for that year. But in no event will it be less than that minimum guaranteed return of 1.5%. So very good offering from Barclays, high minimum guarantee of 1.5%, up to a maximum of 5.5% with the auto cap feature. So another very good looking product. The rest of the products are all index linked, and this is important because I think, folks, if you really step back and pop the hood and look underneath to see how these things work, what's happened is the banking industry has really moved into the next generation of indexing strategies. They were the first ones to come out with it. We don't like to talk about this if we grew up on the insurance side of the business like I did, but the first indexed annuity came out in 1995, but the first indexed market-linked CD came out in 1987. So the insurance industry lagged a little bit behind on indexing theory. Well, unfortunately, I think they're lagging a little bit behind right now as well. And I've talked about the difference between an index that's broad market-based versus some of the market-linked CD indices and their strategies, but I think you're really going to see it demonstrated in the next few products that I'm going to go through, because the banking industry has stepped it up a notch. We're really in the second generation of indexing strategy here, and I think when you really look at these products, you're going to have to appreciate what they've done. Of course, one of our most popular offerings is linked to the Morningstar Ultimate Stock Pickers Index. It's a very attractive product, 6.5-year point-to-point, but put it in the context of a mutual fund more so than an income-generating product. It wouldn't be unusual to hold a mutual fund for 6, 8, 10 years before you captured the return. This isn't really that much different. By the way, the first fixed indexed annuity was a 7-year point-to-point product, so and it did very well. So this is a 6.5-year pure point-to-point product, does not pay annual interest, 115% participation rate in the growth of the index, no cap, and it's linked to Morningstar's Ultimate Stock Pickers Volatility 7% Index. And I've talked about this a lot, but you know what? I don't think I can talk about it too much because this is an absolutely marvelous product. What Morningstar has done is take their expertise, which is in the evaluation of money managers. That's what they do. They look at portfolios and they evaluate money managers and their performance. And they have chosen what they believe to be the top 26 investment managers in the United States. And they use a very extensive criteria for determining who those top 26 are. And then what they've done is they've built an index that mirrors the holdings in the portfolios of those top 26 managers. And then they reevaluate it and readjust it on a monthly basis. Folks, what you have here, I keep saying over and over again, is a dynamic index. This is one that changes every single month. It's not stagnant. It changes to reflect the reaction or anticipation of the top 26 money managers in the country to changing economic circumstances. This is I can't say it often enough, a dynamic index. This is one that is just like having managed money, except it's principal protected and guaranteed and FDIC insured. And of course, in 2013, the index returned 15.5%. Not a bad return on a FDIC insured CD. Last 12 months, it's up another 8%. Marvelously performing index. I always like to point out some of the money managers that Morningstar has chosen. Obviously, Warren Buffett is in there, but also the top guy at Oppenheimer Global, Columbia. You've got Amana Trust and Growth, some great money managers in here. And you'll notice as well that some insurance company money managers are utilized as well. So you've got a good cross-section of styles and strategies here in an index that changes on a monthly basis. It's the next generation of indexing. And you'll see that most recently some of the holdings are, of course, the big boys. You've got Walgreens and Microsoft in there. Coca-Cola is in there. Abbott, UPS, 3M, Cisco, Nike, Costco, all of the, a lot of the big names. But these are what is in the portfolio of the top money managers in the United States, and what a great index to be linked to. And how is it doing for real? Well, here are all of the Morningstar linked CDs that we have issued since June of 2012. And you can see, starting at the top with the 2012 June offering, the current performance is up 18.13%. And you can just go down the line. All of these are positive returns, including the month of April, where it's already up, and the product issued in the month of March is already up over 1%. February's is up over 1.5%. Just some marvelous returns on this product. It's rather like having a mutual fund managed by the top money managers in the United States, where you're guaranteed to get back no less than 100% of your principal in 6.5 years, plus any gains that they achieve. And as you can see from the numbers, the fund is doing quite well. So one of our more popular offerings, and rightly so. JP Morgan Chase, we've talked about. It's a 7-year variable income CD with a minimum annual interest payment of 1% guaranteed, but linked to the JP Morgan High Yield ETF Volatility Index. So it's an opportunity for you to give your clients exposure to the high yield bond marketplace, where the smart money has been going without risking principal, and with a minimum guaranteed return regardless of how the bonds perform. And it is, of course, a product with no cap. It's not linked to, but mirrors the activity in the PIMCO High Yield 0 to 5 year bond fund, but reduces its exposure depending on how volatile bonds get. I've talked about it in another webinar, so I'm not going to spend a great deal of time on it here. But once again, this is a dynamic index. It's not passive. It doesn't sit there waiting for something to happen to it. As things happen, the index reacts on a monthly basis. And as I've mentioned several times in the past, high yield bonds are one of the more popular investment asset classes right now, because interest rates have been held low by the Fed for so long that there just aren't many alternatives except to go to high yield bonds. What a great thing to have a product where you can get exposure to those junk bonds, but without risk to your principal. And once again, a dynamic index that controls volatility by reacting to what's going on in the marketplace. This is my favorite. and I think that you'll find this one very attractive. I alluded to it a little bit in a previous webinar because we knew it was coming. From Goldman Sachs, it's called the Momentum Builder. It's a 5.5-year point-to-point product, but it is multi-asset linked and has a participation rate of 125%. 125% par rate with no cap. Called the Momentum Builder, and it is, in fact, a true multi-asset linked CD. So if you have clients who aren't sure whether the stock market's going to go up or down, if they're not sure what the cycle of the commodities market is going to be, if they're concerned about interest rates, if they just don't know where to place their money, this is the CD for them. This is a transparent, rules-based product. You don't have to worry about the competency of the money manager. This is all math. It uses momentum-based investing, momentum theory, which is a relatively new approach to investing. But simply put, momentum theory says if there is a trend identified, then you follow the trend. Whether it's up or down, you take advantage of that trend. That's momentum-based investing. And it combines momentum-based theory with modern portfolio theory, which we know has been around since Dr. Markham invented it a number of years ago. Combining these two mathematically based systems, what the CD does, it selects and weights different ETFs across multiple asset classes, and then once again, it's a dynamic index, the next generation. It rebalances every month based on economic trends, and it's managed for volatility on a daily basis. And you can see that it is linked across 7 broad asset classes: money markets, developed equity markets like the S&P 500, large economies, U.S. bonds, emerging markets, alternatives like real estate and loan portfolios, commodities, and then inflation-linked U.S. government bonds or TIPS. And each of these different asset classes is limited to a maximum weight in the overall portfolio. So what you have here is a really, really sound product managed across several different asset classes in a principal protected and guaranteed FDIC-insured wrapper. What a great way to invest. Why would people invest any other way? If you could have exposure to 7 different broad asset classes without risk to your principal, why would you want to do anything else? And you can see that this balancing, you see the red chart line in the center there, tends to outperform just about all of the individual asset classes because it crosses across all lines. So very, very excellent product here. How is it done historically? Well, I always get asked for back testing or historical returns, and most of the time I have to disappoint you and say, well, there aren't any because the banks don't provide them because everything changes month to month. But when you have a rules-based CD like this one is, you can apply the rules backwards and forwards. And so you can see here some very, very exciting returns. 2003 down at the bottom, an annual return of 22.47%, 8.03 in 2004, 2.75 in 05, 6.93 in 06. Folks, these returns are just spectacular. You can look at this 10-year run. There's one negative year in there. That's 2008. But of course, no principal was at risk. So you've got an outstanding set of products here for this year. You have the next generation of indexing. You'll notice that with bank products, it's typically linked not to a broad market-based index, but to a proprietary index that has a very specific strategy in mind, a guaranteed return of principal, no fees, and the added protection of FDIC insurance. Folks, for the first time, you can really go in not with a product, but with a plan. You can put together an asset allocation strategy for a portfolio of principal protected and guaranteed FDIC insured products that cuts across several asset classes, most obviously commodities, stocks, and bonds, but also in the multi-asset category across several more. This is really kind of an unprecedented opportunity. Gives you the opportunity to be, in essence, a money manager, but without risk of losing principal. So now you can go in with a plan, not just a product, and mix your fixed indexed annuity in here as well because of its broad market exposure to the S&P 500. Folks, you've got a winner. You've got a winner. So with that, I will take whatever questions you might have. If you haven't typed them into the chat box yet, please feel free to go ahead and do so. Looks like I have a couple in here to begin with, so I will pull those up and respond to as many as I can. Fred asks, how has the commodity account performed? Fred, I just showed you the returns a little bit earlier, so I hope that answered your question. If you'd like to examine those more closely, they are, of course, in the agent portal section of our website, and you can go in and look at each individual offering that we've had, all 10 of the ones that we've put out, and evaluate those. If you need some help, be sure and give your business consultant a call, and he'll pull them up and walk you through them. Jim says, the Morningstar product sounds very good. Why would anyone pick any of the other market-linked CDs? What are the downsides to this CD? Jim, the biggest downside to the Morningstar product is that it does not pay annual interest. It is a pure point-to-point product. That also exposes your client to the possibility, however unlikely it might be, but the possibility that gains made in the early part of the CD could be given back if the market crashes just before it matures. But in no case would the client get back less than their original principal, but there is the possibility, if not probability, that a client could invest for 7 years and only walk away with the money they put in the first place. Again, unlikely, but possible. But I find the biggest reason people do not go into the Morningstar product and go into the others is because of the desire for a guaranteed minimum interest payment on an annual basis. Dick asked to please re-show the initial Goldman Sachs slide. I'll get it to you, Dick, so you can take a look at it. Jim says, please explain how you would explain what momentum-based theory is to a prospect. And Jim, the way I would explain it is to steal from from a commercial. Momentum is the right term. An object in motion tends to stay in motion. An object at rest tends to stay at rest. The same is true of markets. An issue that is going up tends to continue going up, at least for a while. A market share going down tends to trend that way for a while. And momentum-based theory simply capitalizes on those trends, those tendencies. Tony says, a great CD, but how you explain it to mom and pop and the average customer is to, is to keep reminding them that it is a CD and that the returns are calculated in maybe a somewhat exotic way, but in a way that's designed to benefit them. Gary asked, which one is the Morningstar CD again, please? Yeah, that's issued by Bank of the West, and it's called the Morningstar Ultimate Stock Pickers Volatility 7% CD. And you can, of course, find all the information on that CD and all of them on our website behind the agent portal. Richard asks, can you give an example of how the Momentum Builder pays a 125% participation rate? Yeah, very simply, Richard, you measure the point-to-point gain. If it were, let's say, 100 points, 100% gain, and then you multiply it by 25%. So the client would receive 125% gain for purposes of calculating their interest. Not uncommon to do this, especially with fixed indexed annuities. Allianz has been really big on higher than 100% participation rates. And the reason this is possible is because the bank or the insurance company isn't investing directly in the index itself. It is simply buying options based on the performance of that index, and so they're able to pay higher than the index actually gains. And Pat had a similar question regarding the participation rates. If I didn't answer it to your satisfaction, please give us a call and we'll walk you through some calculations. Donald asks, in the Goldman product, after the 5.5 years or the 5 years averaged? No, they are not. It is a pure point-to-point product. Nothing is locked in year by year. These products do not have annual reset. So it's very much like a mutual fund, but with a principal guarantee or a guaranteed return of principal at the end. So no, they do not have annual reset. The gains year to year aren't locked in. It's a strict, pure point-to-point. Richard asks, is there a market to buy back the Goldman Sachs Momentum Builder? No, there is no secondary market created for any of these products, Richard. That's by design. If there were, they would be classified as securities. However, you are able to redeem the CDs at any time by selling them back to the bank. So there is not really a market established, but they are liquid in the sense that the bank will redeem them or buy them back at whatever the market value is at that time. And we do, on a consistent basis, redeem CDs practically every month, some at a loss because the market value has not yet reached the original deposit, and also some at a gain as well. So with that, folks, I think we've got tremendous vehicles for the month of May. Should get your summer off to an absolutely spectacular start. I want to thank you for taking the time to join us today. And as always, I'll be back next week, same time, same place, 11:35 Pacific time. Until then, have a great week. Thanks for joining us.